Usually when we think about a bank, we picture this massive fortress, right?
Yeah, like the giant marble columns.
Exactly. We imagine these thick concrete walls, heavy time steel locks, armed security guards standing around. There's just this deep psychological expectation of permanence.
It's a physical anchor. It's built to make you feel like your money is entirely safe from the chaos of the outside world.
Right. But then you step into the modern financial system, and suddenly that concrete vault is revealed to be, well, kind of a complete illusion.
A total illusion, because today a bank isn't really a building at all.
No, it's just a digital ledger. It's supported entirely by this incredibly fragile web of collective trust. And what happens when someone takes a sledgehammer to that trust? Or actually, more accurately, what happens when a panicked text message shatters that trust in a matter of seconds?
Yeah, that is the defining question of modern finance right now. Because our architecture of trust, it simply hasn't caught up to our architecture of digital communication.
Well, welcome to this deep dive. Today, we are unpacking the jaw-dropping 48-hour collapse of Silicon Valley Bank, or SVB, and the subsequent fall of Signature Bank back in March 2023.
It's such a wild timeline to look back on.
It really is. And we're pulling from a huge stack of sources today, including Wikipedia articles covering the historical records of both collapses, as well as analytical transcripts from the Finance with Jemi and Jones show.
So we have a really comprehensive view of what went down.
Right. And our mission for this deep dive isn't just to tell you that a bank failed. I mean, banks fail sometimes. We want to explore the unprecedented velocity and the actual mechanics of how modern banking panic spreads.
Because the genuinely new element here is how smartphones and group chats basically weaponized a dry mathematical balance sheet problem.
Yeah, they turned it into the fastest bank run in human history.
Unbelievably fast.
And I think we need to set the tone right out of the gate here, because this is not a true crime story.
No, definitely not. There's no villain in a smoky back room here.
Right, we're not talking about a shadowy Enron-style fraud or
Yeah.
some billionaire secretly transferring client funds to an offshore island. No one was hiding fake books.
Which almost makes it scarier. Right.
It does. It's actually this curious and, frankly, deeply unsettling look at how a completely legal, seemingly conservative investment strategy just violently collided with a changing economy.
So to understand how a simple text message can destroy a $100 billion institution, you first have to look at what that institution was actually doing with its cash.
Let's get into it.
And in 2020 and 2021, Silicon Valley Bank had, more cash than they even knew what to do with.
Because the pandemic tech boom was in full swing.
Exactly.
During this time, SVB banked nearly half of all U.S. venture-backed startups. Money was essentially free across the broader economy, right? Venture
Wow.
capital was just flowing like water.
Startups were raising these massive, unprecedented rounds of funding, and all that cash, it had to go somewhere.
Right. Looking at the records, SVB's deposits skyrocketed from $62 billion in March 2020 to over $124 billion by March 2021.
It's staggering.
And according to the transcripts we reviewed, it eventually peaked at around $180 billion.
That is just an absolute flood of capital. And, we saw a very similar boom over at Signature Bank in New York.
Right. They had different clientele, though, didn't they?
They did. Signature historically banked law firms and real estate giants, but they experienced this massive deposit surge because they opened their doors to the cryptocurrency sector back in 2018.
Oh, wow.
Yeah, they even launched their own blockchain-based payment network. It was called Signet, and it facilitated 247 transfers for their crypto clients. So both of these banks were suddenly flush with cash from very specific, highly lucrative industries.
But, I mean, banks don't just take your cash and sit on it like they'd just be a giant mattress at that point.
Right, that wouldn't generate any profit. They have to put those deposits to work.
So what do?
Well, to make a return, a bank invests those deposits. And SVB made a move that, to any traditional risk manager at the time, looked incredibly responsible.
Okay.
They didn't dump this cash into risky crypto ventures or sketchy subprime loans. They parked tens of billions of dollars into long-term U.S. Treasury bonds and government-backed mortgage securities.
Okay. Let's unpack this, because this is where the mathematical trap really gets set.
It's all about the interest rates.
Right. Bonds and interest rates have this inverse relationship that can feel, a bit abstract, but it's actually pretty straightforward when you break it down.
Yeah, how would you explain it?
So imagine you bought a high-end CD player in the year 2000 for $100.
Yeah.
It plays music, it does its job perfectly.
Classic.
But a year later, the iPod comes out, And it also costs $100. If you try to sell your old CD player to your neighbor now, they're going to demand a massive discount.
Obviously.
Right. Why would they pay full price for your old limited technology when they can get the brand new technology that offers a way better return for the exact same price?
That is a perfect way to visualize duration risk. In the bond market, the CD player is a government bond paying a 2% interest rate.
Safe, but kind of boring.
Exactly. It's safe, but it's locked in at that low rate. So in 2022, to fight surging inflation, the Federal Reserve started aggressively hiking interest rates.
And it was one of the fastest rate hiking cycles in decades, wasn't it?
Unbelievably fast. And so the government started issuing new bonds, the iPods in this scenario, paying 4 or even 5% interest.
So suddenly, SVB's massive portfolio of 2% bonds looks terrible to anyone else in the open market.
Right. The only way SVB could ever sell those older bonds to another investor is if they discounted the price heavily to make up for the lower interest rate.
Wow. So the market value of SVB's older low-yield bonds just plummeted as those Fed rates climbed.
Yes. By the end of 2022, SVB was sitting on unrealized losses in excess of $15 billion on their long-term bond portfolio.
$15 billion. But, and I think this is where the accounting rules become super crucial on paper, an unrealized loss isn't necessarily a crisis, right?
No, not at all. It all comes down to how the assets are classified.
Right.
SVB placed a massive chunk of these bonds in a category called held to maturity. Accounting rules state that if you genuinely intend to hold a bond for its entire 10-year or 20-year lifespan, you don't have to report the daily fluctuations in its market price on your balance sheet.
Because the U.S. government is ultimately going to pay you back the full original value when the bond matures anyway.
Exactly. The day-to-day market discount doesn't matter if you never actually intend to sell the thing.
Right. So it only becomes a deadly trap if you are forced to sell those bonds early. Because if you have to liquidate them on the open market today, you have to take that massive discount. You realize the loss.
And that's the nightmare scenario.
Which raises the fundamental question for this whole deep dive. If holding onto the bonds was the safe play, what forced SVB's hand? Why couldn't they just wait it out?
Well, the pressure that forced them to sell wasn't some sudden overnight panic. It was a slow, structural bleed happening right across their specific customer base.
Because the pandemic tech boom had cooled off.
Significantly. In 2022, the music basically stopped. Venture capital funding essentially dried up.
But these tech startups still had massive server bills, expensive office leases, and most importantly, they still had to make payroll every 2 weeks.
Right, the expenses don't just stop. So since they couldn't raise new rounds of VC funding, they had to start draining their SVB accounts just to keep the lights on.
Wow, okay, so it created a classic liquidity crunch. SVB had all their money locked up in these long-term government bonds, but their customers were pulling cash out every single day in a steady, heavy stream.
Exactly. To cover these everyday withdrawals, SVB initially just borrowed money, but eventually they were backed into a corner.
And that brings us to Wednesday, March 8th, when they make a fateful announcement.
A huge miscalculation.
Right. To cover the cash drain, they announced they had to sell a portion of their available-for-sale bond portfolio, which, to be clear, is a different accounting bucket than the held-to-maturity ones we mentioned earlier.
Right.
And they realized a massive $1.8 billion loss doing it. So to plug that sudden hole in their balance sheet, they announced an emergency stock sale to raise $2.25 billion.
Now, what's fascinating here is that taking a loss on bonds and issuing new stock, that is a maneuver that happens in finance. It's not unheard of.
Sure.
For a normal, diversified retail bank, a bank that has millions of checking accounts from teachers, plumbers, doctors, retail stores across the whole country, this might just result in a boring headline on page 6 of the Wall Street Journal.
Right. People wouldn't panic.
But SVB wasn't a diversified retail bank. Their customer base was uniquely homogenous.
They banked the tech founders. And over at Signature, they banked the crypto firms and New York real estate developers. So it wasn't a million regular folks with small checking accounts. It was this incredibly tight-knit ecosystem of highly connected corporate clients.
Yes. And when a bank relies entirely on one specific, highly interconnected industry, any financial distress in that industry becomes an existential threat to the bank itself.
Because the deposits all move in the exact same direction at the exact same time.
Exactly.
But hold on, I want to push back on this a little bit. SVB had over $200 billion in assets at its peak. They were catering to a single, highly volatile industry, parking deposits and long-term assets, while their liabilities were essentially on-demand cash.
Yeah, it's a risky setup.
Right. So how does a bank that massive with that much concentrated risk just fly under the radar of regulators? I mean, weren't there stress tests mandated after the 2008 financial crisis for exactly this scenario?
That is a primary point of criticism in all the subsequent postmortems from the Federal Reserve and the FDIC.
I bet.
Following the 2008 crisis, the Dodd-Frank Act required strict stress testing and liquidity coverage ratios for banks with over $50 billion in assets.
If SVB easily cleared.
Right. But in 2018, Congress passed the EGR-RCPA, which was a major rollback of those regulations. And notably, SVB CEO at the time, Greg Becker, actually directly lobbied for that rollback.
Unbelievable. Because that legislation raised the threshold for those strict mandatory stress tests from 50 billion way up to 250 billion in assets.
Exactly. So regulators operated under the assumption that mid-sized regional banks like SVB and Signature weren't systemically dangerous. They assumed a failure at that level just wouldn't threaten the broader economy.
So SVB was basically left to police its own risk management.
Yeah. A 2021 Fed review actually did find severe deficiencies in SVB's risk models, noting they incorrectly assumed rising interest rates would just increase their lending revenue without hurting their bond portfolio.
Oof.
But without the teeth of mandatory rigorous stress testing, the bank's management just continued pursuing unrestrained growth without building adequate safety nets.
Okay, so the structural trap is fully set at this point. You have relaxed regulatory guardrails, a highly homogeneous customer base, a massive bond portfolio deeply underwater due to rapid interest rate hikes, and a tech sector that is just bleeding cash.
It's the perfect storm.
Which brings us to the defining revelation of this deep dive, the 48-hour freefall.
Because when that spark hit on March 8th, it didn't just catch, it exploded.
And it exploded instantly through their digital networks. I mean, this is fundamentally different from historical banking panics.
Yeah.
This was not 1929.
No.
We aren't talking about people in fedoras standing in physical lines around a city block, banging on the glass doors of a branch manager's office. This bank run was powered entirely by Twitter, Slack, and private WhatsApp group chats.
It was a true digital stampede. Prominent venture capitalists, including executives at Peter Thiel's Founders Fund, Union Square Ventures, and several others, they saw SVB's stock sale announcement. They immediately recognized the liquidity danger, and they urged their portfolio companies to pull all their cash out right that second.
Here's where it gets really interesting. Think about the old analogy of someone shouting fire in a crowded theater.
Right.
Historically, if panic starts, people still have to scramble over seats, push through narrow doors, and physically escape, right? The friction of physics actually slows the panic down.
That's a great point.
But imagine if someone shouts fire in a crowded theater, except the theater is a global Slack channel, and every single person in that channel has a banking app on their smartphone that acts as a teleportation device.
That is exactly it. You don't have to put on your shoes. You don't have to drive to a branch or even wait for the bank to open. You press a button on a screen, and tens of millions of dollars move across the financial system in milliseconds. The friction is completely gone.
The velocity is just astounding. On Thursday, March 9th alone, customers initiated transfers to withdraw $42 billion in a single day.
$42 billion.
Just let that number sink in, trying to exit the door in hours. By the morning of Friday, March 10th, SVB had a negative cash balance of nearly $1 billion at the Federal Reserve. They literally couldn't clear the transactions to open for business.
And that's when the California regulators and the FDIC had to step in immediately and seize the bank.
It's just breathtaking speed.
And this raises an important question about contagion. Contagion in finance is deeply psychological, and because of digital networks, it travels just as fast as the initial panic. The fear couldn't be contained to just California.
Right, because just 2 days later, the panic shifted across the country to Signature Bank in New York.
Exactly. And Signature was incredibly vulnerable because they had that 30% exposure to the cryptocurrency sector.
Ah, right.
And context is vital here because earlier that same week, Silvergate Bank, which was another institution that was hugely crypto-friendly, they had announced they were voluntarily winding down operations after suffering their own massive run.
Oh, wow. So you have nervous corporate clients looking at the smoking crater of SVB on Friday, looking at the collapse of Silvergate earlier in the week, and then looking at Signature's heavy crypto exposure.
The fear just jumps the fence instantly.
Right.
On that single Friday, terrified customers pulled more than $10 billion in deposits out of Signature Bank. By Sunday, March 12th, New York regulators had to shut Signature down.
making it the third largest bank failure in U.S. history, sitting right behind SVB, which has literally just become the second largest.
Two massive, deeply established financial institutions completely wiped off the map over a single weekend. And it was largely because corporate treasurers in group chats got spooked.
The sheer, unprecedented speed of this digital run absolutely terrified the U.S. financial system. Which brings us to the aftermath and the massive, very noisy debate over the government's intervention.
Regulators realized they were staring down the barrel of a widespread panic. I mean, if corporate clients at other regional banks, places like First Republic or Western Alliance, woke up on Monday morning and decided to move their funds to massive, too-big-to-fail institutions like JP Chase.
The entire regional banking sector could collapse in days.
Exactly. So over that weekend, the Treasury, the Federal Reserve, and the FDIC invoked what is called a systemic risk exception.
And this exception fundamentally altered the rules of the game, because standard FDIC insurance only protects your deposits up to $250,000, right?
Right, which covers the vast majority of everyday Americans.
Exactly. But at SVB and Signature, nearly 89% of all deposits were uninsured. We're talking about startup operating accounts holding tens of millions of dollars.
So under the systemic risk exception, the government guaranteed that all depositors at SVB and Signature would be made completely whole. Every single penny was protected, well beyond the $250,000 limit.
Wow.
Furthermore, the Federal Reserve created a brand new facility called the Bank Term Funding Program, or BTFP.
Yeah, the mechanics of the BTFP are actually pretty brilliant, if highly controversial.
How so?
Instead of forcing other regional banks to sell their underwater bonds at a massive loss to cover withdrawals, the Fed allowed these banks to pledge those bonds as collateral for a loan.
Oh, interesting.
Right. And the critical detail here is that the Fed valued those bonds at their original par value, not their current depressed market value. So it effectively erased the duration risk that killed SVB, at least temporarily.
That's a massive lifeline. And looking at the sources, the systemic risk exception and the sweeping backstop, it sparked a fierce political and economic debate. And it is fascinating because it completely fractured standard partisan lines.
It really did. So let's lay out the arguments here impartially, because both sides are highlighting fundamental tensions in how our economic system functions. And we're not here to take a side.
Right.
On pro-intervention side, you had lawmakers like Representative Ro Khanna and State Senator Scott Wiener alongside prominent venture capitalists. Their argument was heavily focused on the immediate real-world economic fallout.
Yeah, they pointed out that if those uninsured deposits evaporated, thousands of startups would instantly miss payroll that very next week.
Right. People need to get paid.
Exactly. It wouldn't just be wealthy venture capitalists taking a haircut. It would be everyday tech workers, administrative staff, and engineers suddenly finding out their paychecks bounced.
So the argument there is that intervention was strictly necessary to prevent massive job losses and protect the broader innovation economy from a catastrophic, entirely avoidable disruption.
But conversely, on the anti-intervention side, you had a very unexpected alliance of politicians, ranging from Republicans like Matt Gaetz and Nikki Haley to Democrats like Senator Elizabeth Warren.
Quite the mix.
Yeah, and economists weighed in heavily on this side as well. Their arguments centered on the concept of moral hazard.
And moral hazard is a foundational concept in economics. It basically dictates that if market participants know the government will always step in to catch them when things go wrong, they're heavily incentivized to take wilder, more irresponsible risks.
Exactly. The critics argued this was essentially a backdoor bailout for sophisticated, wealthy investors and venture capital firms.
Because these were entities who actively chose to put all their eggs in one uninsured basket for convenience, right? They ignored basic risk management.
Yeah. And by invoking the systemic risk exception, the government sent a signal. You don't need to diversify your deposits across multiple banks, because if the bank is big enough, the FDIC will save your uninsured money anyway.
Right. It's this massive debate between saving the immediate victims of panic versus setting a dangerous precedent for future financial recklessness.
Ultimately, the official postmortems from the Federal Reserve and FDIC didn't mince words about the root causes.
No, they do.
If we connect this to the bigger picture, they blamed a toxic cocktail. You had rapid, unrestrained growth pursued by bank executives who deeply mismanaged their interest rate risk. You had a regulatory rollback that allowed these banks to operate without necessary guardrails. And you had a homogenous customer base that acted as an echo chamber.
Though you might be listening to this right now thinking, I don't run a tech startup. I don't have $50 million in uninsured deposits, so why does this matter to my checking account?
Fair question.
But this story reveals the invisible architecture of the money in your pocket right now. Because your money isn't physical gold sitting in a heavy concrete vault.
Yep.
It is a digital entry on a screen. And its value, its availability, is supported entirely by collective belief.
SVB and Signature didn't fail because they were running a Ponzi scheme. They failed because of a basic math problem with interest rates.
Right.
But that mathematical vulnerability was weaponized by the hyper-connected, lightning-fast speed of modern digital communication. The financial system was built for the speed of paper, but we live at the speed of the internet.
Which leaves us with a lingering and oddly a pretty unsettling question to chew on as we wrap up this deep dive. If a 40-year-old, $100 billion financial institution can completely evaporate in 48 hours simply because people in a global group chat got spooked,
Hmm.
what other trust-based systems in our digital society are vulnerable to the exact same dynamics?
Wow. Yeah, it forces you to look differently at everything from global supply chains to national elections to digital currencies. They all rely on the exact same collective trust.
If the concrete vault can be blown up by a text message, it makes you wonder what else in our lives is just one viral panic away from vanishing. Thanks for joining us on this deep dive. We'll see you next time.